What if everything we believed about the AI revolution, the future tech gold rush, was completely backwards? It started with a single report, just one, published quietly out of MIT, but within hours it sent shockwaves through Wall Street. Nasdaq sank 1.46%, AI stocks crushed, Nvidia fell 3.5%. Palantir nosedived nearly 10%, ARM dropped 5%. So what happened? Why are markets panicking? And more importantly, is this the beginning of a much bigger correction? Here at Epoch Report, we dive beneath the surface. Because what's buried at the end of this story might just reshape how you see the entire AI sector and the valuation of US equities themselves. Do you think this AI crash is just getting started? Yes or no? Let us know in the comments. The panic that gripped tech investors this week didn't start with earnings reports or macroeconomic shocks. It began with a study from MIT titled The Generative AI Divide, the 2025 State of Enterprise AI. This wasn't just academic analysis. It was built from real-world corporate feedback, minus 150 interviews with business executives, surveys covering 350 AI team members, case reviews of 300 AI deployment scenarios, and the conclusion. Brutal. MIT found that 95% of companies investing in generative AI have seen no financial return to date. That's not a typo. 95%. For all the hype, most AI initiatives aren't moving the needle on revenue or profitability. The market had been pricing in transformation, not stagnation. And that disconnect triggered a crushing reassessment almost overnight. Let's be clear. The report doesn't argue that AI itself is broken or useless. In fact, its most sobering insight is this. The failure isn't in the models. It's in the organizations trying to use them. According to MIT, the top barriers include inadequate internal tools and infrastructure, a lack of cross-team learning and coordination, strategic misalignment within companies themselves. Yet many executives continue to blame their struggles on external factors, like regulatory hurdles or perceived algorithm weaknesses, rather than facing the internal dysfunction holding them back. This disconnect isn't just academic. It has real financial consequences, fueling the very bubble behavior that could now be unraveling. If all this sounds familiar, it should. The MIT report has sparked comparisons to the early 2000s dot-com bubble. Back then, investors poured billions into internet startups with big visions but little viability. When those promises failed to translate into profits, the bubble burst. The Nasdaq lost over 75% of its value. Today we see similar warning signs. Massive capital investment chasing emergent tech. Valuations based on future hope, not present delivery. A market increasingly concentrated in a handful of tech firms. And with AI implementation already faltering at most firms, once again, the returns aren't justifying the hype. One of MIT's more practical takeaways should have been headline news by itself. Companies trying to build their own custom AI tools were significantly more likely to fail than those purchasing ready-made AI platforms. Why? Speed, integration, scalability. Off-the-shelf solutions come battle-tested, while internal systems are often mired in bureaucracy and lack agility. This adds another layer of concern. Most current enterprise strategies are poorly matched to realities, and change is proving too slow to avoid project churn. Now here's the twist. Even the people building these systems are worried. Sam Altman, the CEO of OpenAI, arguably the face of the generative AI revolution, recently sounded his own alarm. He warned that irrational exuberance is already inflating asset prices across the tech sector. And if momentum outpaces execution, many investors are likely to suffer massive financial losses. Altman's message wasn't pessimistic about AI technology, rather it was about human nature. How easily we let our expectations run wild with the arrival of every next big thing. Karl Marx once pointed out that new technologies always begin with overconfidence, only to later correct through economic reality. The question is whether we've reached that correction point now. Let's take a look at valuation metrics. The S&P 500's price-to-book ratio is now 5.3x, higher than at the peak of the 2000 bubble. Forward price earnings sits at 22.5x. The famous cyclically adjusted Shiller PE ratio is at 38.6. Historically, anything above 25 signals speculative risk. This points to a crucial truth. The danger isn't generative AI, it's overpriced expectations. When investor sentiment becomes irrational, corrections become inevitable. And suddenly that 3.5% loss in Nvidia isn't a fluke. It's a possible starting point. If you're still watching, you're clearly not here for surface-level takes. Make sure you click to follow Epoch Report and turn on your bell notifications, because we go beyond hype into the forces that actually shape markets. Let's zoom out. Here are the steepest declines for the S&P 500 across the past decade. March 2020 COVID-19, minus 32%. 2022 bear market led by rate hikes, minus 25%. 2018 trade war, minus 7.5%. 2024 so far, down about 7.4%. Again, tied to geopolitical risk, what these events share, clear, tangible catalysts. Now consider this. Since 1929, the only 3 times markets lost over 50% were during the Great Depression, 86%, the Internet bubble, 49%, the global financial crisis, 57%. What do they have in common? Mismatch between expectation and actual economic value delivered. And that's exactly the fear now brewing around AI. We don't believe today's AI sector is doomed to collapse like the one in 2000. But we do expect small and mid-size AI startups to face a severe reckoning. Think 80 to 90% downturns ahead. The giants, however, that's a different story. Let's check the valuations. Nvidia, pay of 57. Stretched, yes. But with real earnings growth, Google, pay 22, pretty reasonable. Microsoft, pay 37, elevated. Not excessive. Meta, pay 27, supported by consistent earnings upside. At Epoch Report, our view remains clear. Focus on giants with actual cash flow. It's not hyped up microcaps running on storytelling alone. But here's another structural shift we can't ignore. The so-called Magnificent Seven tech giants now make up over 34% of the S&P 500's. Wait, that concentration is historically unprecedented. And if you compare equal-weighted indexes with market cap-weighted ones, you'll see a chasm. The S&P's equal-weighted version is underperforming dramatically, meaning only a few stocks are doing the heavy lifting. Sound familiar? In 2000, a few high-flying dot-coms inflated indices right before collapse. But here's where the script changes. In 2000, tech companies were burning cash with no profits. In 2024, the top tech firms are delivering real results. 6 of the 7 tech giants saw quarterly earnings grow 26% year-over-year. Minus 2025 earnings outlooks are being upgraded for these firms by 1%. Meanwhile, the rest of the S&P EPS projections are being cut by 4%. So while market concentration is high, it's backed by fundamentals this time. It's not just speculation, it's performance. When major U.S. indices drop hard, it's usually a major trigger. From the dot-com crash to pandemic panic to the financial crisis. So what about now? What's the big threat? Inflation is easing. With oil prices stabilizing, the job market remains soft but not collapsing. Trump focuses on peaceful messaging, not military confrontation. Fed Chair Powell faces pressure to cut rates, though weak labor data may complicate timing. In fact, we see several reasons for cautious optimism. No imminent black swan, no collapsing sector yet, but there's volatility on the horizon, not crisis. We anticipate a period of consolidation. The market may wobble, up a few points, down a few. But it's not on the verge of disaster, at least not without a new, unforeseen catalyst. Could Powell's next speech trigger volatility? Maybe. If he comes off more hawkish than expected, equities could react sharply. But a more dovish tone could keep the rally alive. What we're watching for now is this: a sideways market. Consolidation, rotation, not daily meltdowns, but not melt-ups either. I want to hear what you think. Is this AI correction a ticking time bomb for the whole market, or just a much-needed cool-down? Drop your thoughts below. We read and consider every comment. If this deep dive helped you see things more clearly, don't just like it. Follow our channel and hit the bell. Because in markets like these, timing and insight matter more than ever. And here at Epoch Report, we'll make sure you're never caught off guard.